It's the question is, what are you focused on?
Exactly.
And if you're an institutional shop, you're focused on scale and fees, really. But if you're independent and you're nimble and you're doing things the way Trajan does things, and we've been partnered for a while, and I've seen this firsthand. We're doing this because we want what's best for our client, and we believe ultimately that will continue the success of the firm because we did it well.
Every day you turn out CNBC or Bloomberg, you see a ticker tape showing prices of stuff, right? Whether it's Apple stock or Microsoft stock, all that is public. It's exchange traded. Most of the bonds, they're not exchange traded, but they're traded in an institutional basis across the world, across the banks, right? That's all public. Anything that is for which you can't trade it on a daily, intraday basis or a daily basis, and you just have to basically source somebody to buy it, and that's going to be private.
Ultimately, it's the SEC determines what are private markets, what are public markets. But public markets require those who are engaging in them to, like the companies that are listed or the bonds, to publicly report. So there's all this information, and it's somewhat standardized across the board. It's Apple, it's all the stocks we all know about. They're traded on the NASDAQ or NYSE. And there's a visible market I can watch, and to your point, on Bloomberg or CNBC, I can see it happen all day long, the ticker. There's no ticker for for private markets. This is just transactions that are happening. Someone sells their ice cream shop. Technically, that's a private equity transaction, right? So certainly if they sell 16 of their ice cream shops, and so it's not as observable. In fact, it's limitedly observable. And I think that's the big defining characteristic. But it also creates the opportunity. It's not as well covered. It's not as well understood. So if you invest in a fund manager or someone who is an expert in that space, you get the advantage that they have by knowing it well. The primary risk of being in private markets is actually the illiquidity risk. And risk in private markets is almost all illiquidity risk. And you get a premium for it. It's called the illiquidity premium. And so it's 200 or 300 basis points, which means 2 or 3% a year. That's about what it appears to be. And so what you're basically doing is you're saying, I'm going to make a trade as an investor. I'm going to lock up my capital for a period of time in order to make a greater return. Well, you're already doing that in retirement assets. You're not getting to it until you start spending it down. Maybe it's 10 years away, maybe it's 5 years away, maybe it's 40 years away. And so it's a great place to place these kinds of assets because you weren't accessing that capital probably anyways. And I think presumably that's where some of the thought is why we should actually approve having these private assets in these plans. The correlation, everyone talks about correlation. I know it's kind of a nerdy concept, but it's the reason you want to be diversified. Because if your stocks and your bonds move together in sync every time anything happened, well, there's no benefit in owning two different types of assets in general. They obviously could have different revenue lines. But and so when you go up market and you're in these large cap PE firms, they're much more correlated with what's happening in the stock market. So the benefit you're getting from being in a huge private equity fund when you already own the S&P 500 or Dow it's more muted. You get a lot more benefit, and you both not just in terms of the return from being lower middle market or middle market, but also in risk reduction, because when this is zigging, that's zagging, and that's what you want. That's the benefits of diversification. So it's not just to be different for different sake, and it's not just for higher returns. It's actually for lower risk, and it which seems to kind of the naked eye not true. You're like, oh, smaller companies are lower risk, and they are if you own the right amount of them, because they don't move with the rest of the market in the same way. We kind of think of it as two main groups. There's independent advisory firms that are boutique on purpose. They think they can provide and often can provide greater value to their clients by being independent. And independent means not like the other guys, which is the large wirehouses, or what we call wirehouses, the Merrill Lynch's and Goldman's. And there's some great things, I guess, about being big, but there's also some really big downsides. And one of them is what they can access. If you're a very big firm, you're providing your clients the biggest funds, the mega funds, the the Blackstone REITs or these large institutional managers, and you're not going to the middle market and down. So the advantage to a Trajan and someone who's not just positioned to like from a size standpoint, but that is open to how do we create more value for our clients by bringing access to the best things, they actually can. Whereas, it's kind of by no fault their own, Goldman can't. And so I think that is the big difference, and that's the major. To me, that's the value proposition.
That is the value proposition, and really,
the question is, what are you focused on?
Exactly.
And if you're an institutional shop, you're focused on scale and fees, really. But if you're independent and you're nimble and you're doing things the way Trajan does things, and we've been partnered for a while, and I've seen this firsthand, you're able to say we're doing this because we want what's best for our client, and we believe ultimately that will continue the success of the firm because we did it well.
And primarily at Trajan Wealth, we manage retirement money because you're talking about people financing their lives after their earnings capacity has been exhausted, right? Mm-hmm. So that's why we think that curating all the investment opportunities in the alternative, asset class to what's suitable for our clients is critically important. And that's why I think the role of an investor or a firm like Trajan to be the guide is that much more prominent against the public markets. Because in the public markets, you have index products, right, which basically, for very low fees, you can access. And if you don't want to do anything but get broad diversification, all you need to do is buy an index product. But in the private market, there's so many different things with different risk-reward profiles. It's really important to identify your goals and construct your portfolio with what really is appropriate for you. And that's where I think, as a firm, Trajan Wealth can be a very good intermediary in helping you achieve that.
One of the harder things about alternatives just in general is for the regular person, the regular investor, figuring out what is the risk here. Is it 10% I should have, and is it 30%? How much should I have in commercial real estate versus private equity or some like a fixed income fund, right? Or I should say private credit fund. And that's where I think the having an advisor is so important, is that they can come in and they can contextualize because they know their client, and they can say, okay, this is probably the band that you need to be in, at least right now. And then as we grow assets, we can get bigger, or whatever the plan is to serve their needs. And I think that's a lot of it. It's less understood. It's not as transparent to the normal person what they're taking on.
A clean, data set that would allow you to make that decision,
right?
You have in public markets.
It's getting there. It's more than it used to be. You need a guide, and I think that's really important.